Thank you for joining us today. We're waiting for everyone to join, letting everyone in from the waiting room. So we'll wait a few minutes so everyone gets in and settled. Okay, I think it's in lieu of time, we will get started here. My name is Katras, and I am with University of Minnesota Extension and Center for Family Development. And we are again happy and very excited to be here and helping to host and facilitate Taxes 101 Part 2. Some of you may have joined Part 1 earlier in the week. And if not, you can send out resources from that as well if you put your name and email in the chat. But today we are providing Part 2, and Taxes 101 is something that we've partnered with Minnesota Legal Aid, Prepare and Prosper, Lutheran Social Service for many years. And so, like I said, we're excited to be here hosting again. So I want to introduce my colleagues that are part of today's webinar. We have David Langley from Prepare and Prosper, Aisha Servaty from Minnesota Legal Aid, and Shawna Thompson from Lutheran Social Services of Minnesota. So welcome to my colleagues and partners in this effort, and it's all it's bringing together lots of different expertise that we have from each of our organizations, and knowing that we all kind of share in this in helping to support the tax season this year again. So I am going to, we have just a few housekeeping things I want to mention before I turn it over to Shawna. Please ask your questions in the chat, and we will be monitoring those, and we will make sure that they are answered either throughout the webinar or at the end. If there is a question that we don't get to, we can send that out in a follow-up email as well. So, but please, let's use the chat as a way to communicate during the presentation with any comments or questions that anybody might have. So with that, I'm going to turn it over to Shawna to talk about our resource guide that we have this year.
All right, thank you, Mary Jo, and hello, everyone. I see lots of familiar faces on the call. I just did a quick little scroll through the attendees, and just hello to everybody new and not new. My name is Shawna Thompson, and I'm the Financial Counseling Program Director at LSS Financial Counseling. I've been in this role for about 3 years, and but I've been in the financial capability field for just about 20 in a number of different roles. And with that, I've been able to be a participant of this training every year, and even move on to presenting. And now I'm helping plan and facilitate these trainings as well. So I know it's something that when I was working with clients, I really looked forward to this every year. It's a really nice way to just kind of, when you're not knee deep in taxes all year round, it's a good way to kind of get a refresher and just see what's new and what's coming, and how you can talk to your clients. So thanks everybody for being here. If you were here on Tuesday, you kind of heard the similar spiel. And for those of you that weren't here on Tuesday, traditionally how we've kind of done these trainings, whether it was in person or virtual, we have a tax section, and then we have a resource section. And what we've done this year is really put all of those resources into a guide, a document that you all will receive if you haven't already, that goes over, and I see that Mary Jo just put the link there in the chat for you to download it. So that's there for you. But yeah, so it's a place where all of the resources can live, and you can access those anytime you need to throughout the year. I'm not going to go through the whole guide, but just to kind of give you an idea of what's in it, there are some sections that you'll take note of. There are some financial wellness organizations that may be helpful for you to make referrals to your clients during the tax season. There's a section for resources for taxpayers. We've got our money moment section. So really maximizing, we talk about tax time as the money moment time. And so how to talk to your clients about taxes and savings, just kind of some conversation starters in that section for you. And then we've got a section on finding free tax prep, which, David reviewed in depth on Tuesday from Prepare and Prosper. And all of those resources are listed here in the guide for you as well. Then we've got just some other miscellaneous tax resources too. So that's about it for the guide. I am going to turn it over to my colleague Aisha, who is going to fill us up with knowledge about taxes for this season. So take it away, Aisha.
Thank you, Shawna, and thank you, Mary Jo. My name is Aisha Servaty. I don't use pronouns, so please use my name, Aisha. I am an assistant supervising attorney, and I am the director of the Low Income Taxpayer Clinic at Mid-Minnesota Legal Aid. And so what we do is we represent low income taxpayers in disputes with the IRS and related disputes with the state of Minnesota. And so just to give you an idea of the agenda that we'll be talking about, we'll be talking a lot over the next hour and a half. I'll try to leave a lot of time for questions throughout, though. There is a lot of material. I did go in depth about the new changes in the tax law for 2021 specifically, with some of the really big credits for low income taxpayers specifically, since that's my focus as a tax attorney. And I think a lot of our focus is as service providers, is the low and middle income taxpayers. I went through those on Tuesday, so I really recommend that if you attended that you look at that recording again, and that, if you didn't, like Mary Jo said, put in your email, we can send you that recording. So I'm not going to go as in depth. I mentioned a lot of them in this presentation in the slides, and I'll just mention them briefly here again, but I went a lot more in depth when I had more time to do that. And so if you do have more questions about that, if I have time, I can answer more questions, but I really recommend going back to that recording or emailing me, and I can definitely give you a lot more information and resources about a lot of these tax credits and deductions. Or if you do have specific client questions, please, you can email me those and I can give you advice and referral information for client specific information. So if you have that, please wait and give me that information personally at the end. So we'll be talking about some tax basics with some terms, filing status, withholdings, and ITINs. I'm going to talk a little bit about tax deductions, a lot more about tax credits on the federal and state level, and then some post-tax return filing considerations. I try to add more to this presentation. This is a basic presentation that we do give every year, adding, and updating information about the specific amounts, any changes that happen with new legislation and law, but the outline is generally the same. I did try to add more about filing status and talking more about that. We've added more about ITINs and withholdings in the past few years. I did try to add a little bit more information about the state of Minnesota. I will note, though, I'm a federal tax attorney, specifically focused on low income. I'm not a state and local tax attorney, a SALT attorney. If you are looking more at state tax issues, I really recommend consulting more directly with the Minnesota Department of Revenue. Honestly, calling the Minnesota Department of Revenue, even now during the pandemic, I wait maybe 5 to 15 minutes or so to talk to someone, and they're really helpful. They can give a lot of information, answer a lot of questions, a lot easier than the IRS. So I really recommend, if you have specific state questions, contact the Minnesota Department of Revenue. The Volunteer Lawyers Network can give some specific information. They have a couple, I believe one attorney maybe that helps with some state tax issues. So they might be able to help a little bit with some information. Or you can contact me if you do have a federal and a state tax related issue, and I can help answer some information about that state tax issue. So I just want to put that out there for your questions in case you have some more in-depth state ones. I'll probably have to research that more or refer it out to someone else. So I'm going to start with some important dates. And so I did add more dates to this than normal. I was a little proud of myself for doing some more research on this. So filing season did begin. It just began this week on the 24th. And so people can start filing. So the online had already started for individuals to start being able to file online. 24th is the official date that things could start being processed. So that has started for people. And so people can start putting in their returns. People can start going to those VITA sites that David talked about and TCE sites to start getting appointments to start filing their tax returns as well. People can use online resources. People can go to tax preparers. So I know there's a lot of misconceptions because I had clients, even professionals, think it started in February this year. And that's not true. It has already started. So I just want to kind of tell people that because there are a lot of misconceptions. Employers have to send those W-2s, 1099s by January 31st. The IRS is sending its end of year notices by January 31st. So just in, by next Monday here. I just know personally, some of my friends just got their 6419 advanced child tax credit notices in the mail yesterday. So the IRS is sending them. I know, like, I just got my 6475, EIP and economic impact payment, third payment notice. So the IRS is sending those. So people are getting them and people need to keep them. So make sure you remind your clients that the IRS is sending those end of year notices and people should keep them for their tax preparation purposes. We did talk more in depth about that on Tuesday. So I recommend doing that recording, but that is a notice date. Tax returns are due April 18th this year. So not April 15th, April 18th due to Emancipation Day. And then this year I added information about estimated taxes and quarter dates because I think that is so important for our self-employed clients because they are low income and middle income clients as well. And it's really important that they meet the deadlines of their estimated taxes because those are actually requirements for things that I do as an attorney when I represent them and try to help them with their tax debts. So I think it's important for us to remind our own clients when you're talking to your clients about estimated taxes and due dates and that they meet those dates. So the estimated taxes for quarter one are also due on tax day of April 18th. Quarter two is June 15th. Property taxes are due August 15th. Estimated taxes for quarter three are September 15th. The extended returns date is October 17th this year, not October 15th. So just noting that. And then quarter four is due January 15th, 2023. Because you get that extra time after the end of the year. So they always are due in January of the following year for quarter four. And so looking at when is someone actually required to file a tax return? So this is your actual filing obligation based on your income. And so you can kind of see the table here, it based on your filing status, which we'll talk a little bit about, and your age that you're at, and then the amount of a gross income that you have. And so you can look at, for example, single under 65 is $12,550 this year. It does slightly increase based on just adjustments every year. And so like last year is 12,400, this year is 12,550. So it does slightly change with inflation every single year. So that's a main number that I often look at is the single under 65, which is a main number for a lot of my clients. If you have 65 or older, that 14,250 will be important. It's also important to remember these numbers and remember the numbers. If your clients receive Social Security income only, do know that the numbers are different if your client receives Social Security number. I'm not going to go in depth about that. If you do have specific questions about that, email me if you have a client who receives Social Security income to determine if their income is taxable income and they have a filing obligation. That's something completely different, and I could go into an hour presentation just about that. Married filing jointly, a lot of times with both spouses being under 65, it's $25,100 this year. Married filing separately, it's honestly, it's kind of hard because it's just like $5 or more. I mean, it's kind of unfair in that way. If you're doing married filing separately instead of married filing jointly, you basically have to file a tax return. Head of household is $18,800. And then we don't really do too much with a qualifying widower with a dependent child, but that is the same amount as married filing jointly. And then self-employed is $400. So it is most people that have self-employment income. And I won't talk too much about self-employment income this time around. But if you have more questions, again, you can always talk to me or ask me to give a presentation to your organization about self-employment. But that is, $400 or more, which isn't that much money, especially when people might be considered self-employment when they have hobby income. But who should file? So those people who have had income withheld from their pay, even if they don't have that filing obligation, maybe should file because they can get those taxes that were withheld back as a refund, even though they didn't have a filing obligation. If they qualify for certain credits, especially that earned income tax credit, that child tax credit this year, which is a big credit, the child independent care credit, which has become a big credit this year, the American Opportunity Credit, if they qualify for that, based on education credits. If they had the economic impact payments, that recovery rebate credit, and did not receive their third one this year, or didn't receive the first two for 2020 and need to do a 2020 return, or they rent or own a home in Minnesota and need that property tax refund or renter rebate refund. And so to talk a little bit about taxable versus non-taxable income. So I think it's important to know the difference. So your taxable income must be reported. And so those are your wages and salary, your non-employee compensation, so your 1099 income, your unemployment, retirement plan distributions, cancellation of debt income, which a lot of people don't think about. So if you had debt that was canceled by a bank, certain student loan debt, again, that hobby income is taxable income. So a lot of people don't understand, like maybe they started doing things on Etsy, and if they were earned enough money, if they did it for a certain purpose to actually sell the money and earn some income, then it becomes more than just doing something because it was fun. It was doing something to earn some income. It's taxable income. They need to include it on their tax return. Also, some people don't think about, and we'll talk a little bit about this, and I talked about this on Tuesday with a child independent care credit. If you're watching someone's kid and they're paying you money, technically that is taxable income. I mean, income that you are receiving from other people, it is taxable income. So then we look at non-taxable income. So it's important to know taxable income versus non-taxable income for certain credits, like the earned income tax credit. So is it earned income or not? So non-taxable income does not need to be reported. So example are public benefits, child support, alimony for divorces finalized after 2018 with a difference in the with the tax code, gifts, inheritances, things like that are non-taxable income and therefore would not be reported. So that non-employee compensation, again, would be like 1099 and miscellaneous income, and you'll receive that an actual statement, a 1099 from your employer, and you might be treated, for example, like an independent contractor, self-employed. And if you are, then you're responsible for paying all of the income, the Social Security, the Medicare taxes. So normally your employer pays half and then you pay half as an employee. Well, when you're an independent contractor and self-employed, you pay the full amount. And people don't realize that because nothing is taken out of their pay, right? Nothing is withheld. Then they get this 1099 and it shows the amount that they were paid. Nothing was withheld, and then they get to do their tax return, and all of a sudden they're owing all this money that they didn't realize they were going to owe. And that can cause a lot of problems. And so it's important that people get a tax preparer that can help them prepare their taxes correctly. And then if they can't afford to pay, that they contact like a low-income taxpayer clinic that can help them with collection alternatives to help them with that. So it's important to know that. Something that we are doing is a worker misclassification project with our attorney, Eric Beaudry. So I included his information that if you do have clients that were potentially misclassified, so they're classified as an independent contractor, but they are actually a W-2 employee, that can contact our clinic, and we can work to see if that is the case and work with them to be properly classified. So unemployment compensation was a big thing with the pandemic. That's a 1099-G. It is taxable income. A lot of people didn't have taxes withheld from it, especially during the pandemic. They will oftentimes owe taxes. That was especially seen and anticipated in 2020. Then, the approximately $10,000 was considered excluded. That hasn't been done for 2021. So that additional $300 per week for the COVID-19 unemployment compensation is taxable income in addition to what was otherwise received. And so if people didn't have tax withholdings, then they may owe taxes if they didn't have enough in credits and deductions in order to cover that. So as always, to minimize liability, they can file a W-4V, they can make estimated tax payments, or they could increase their withholding when they start new employment. So those are just ways people can work around that. But they will receive a 1099-G, which will include their employment compensation. It will also list anything they did withhold from taxes, because they can have taxes withheld. It's just a lot of people didn't realize it, and so they may not have done so. I'm hoping more people did and did learn from 2020 and did change that for 2021, but we'll kind of see when we get the 1099-Gs from our clients. I do want to talk about filing statuses this year, because I think it's important, because I've had a lot of issues with clients with filing statuses, and a lot of people not realizing things with filing statuses and having the IRS get audited for filing status, or not be able to take advantage of credits or deductions, or taking advantage of credits and deductions and not realizing they could because of their filing status. So the filing status is important for purposes of determining which deduction that you're taking, as well as the impact of certain credits and deductions. Because if you file a certain way, for example, married filing separately, if you file married filing separately, there are so many credits that you are unable to take advantage of because of that filing status. And so that is something that I tell clients. And, as an LATC, I will mention this, we do not prepare and file tax returns. We recommend people go and refer them to a volunteer income tax assistance, a VITA site or a TCE site, in order to assist them with that. Especially Prepare and Prosper is the main one that we do for our clients, especially those in the Twin Cities area. Or if they're unable to do that, to do a low bono or pro bono tax preparer, they're able to find one, but to really talk to that tax preparer about their filing status, because it really impacts those credits that they're able to take. And at the end of the day, what is the best tax return for them? So I list the filing, the 5 filing statuses that there are, and the main one that we really talk about when we're looking at it is head of household something that someone is able to take, and then a lot of times talking about that married filing jointly versus married filing separately for people that might apply for. And so for married filing jointly, they must be married on December 31st of the tax year. And so a lot of times, I see this even in divorce decrees. And when I was a law clerk, I must say my judge would do this as well, is they would be like, well, we got to do what's best, economically, for the family unit. So in the divorce decree, they might even order, well, you must file married filing jointly, but they might also, the divorce might also be finalized, and they might not be married on December 31st of the tax year. Therefore, they legally cannot do married filing jointly. And so you need to think about that even as a family law attorney, or as an attorney with clients going through divorces. You have to be married on December 31st of the tax year in order to do married filing jointly. If you are not, then you cannot do a married status. You must do single or head of household status. So those are things to think about of what you are even qualified for doing. And like I said, for the married filing separately, one thing to know is most spouses must claim standard or itemized. If one spouse claims standard, then the other spouse must do a standard deduction. If one spouse itemizes, the other spouse must itemize. And then again, there are so many credits and deductions that are unavailable if you do married filing separately. And then there is a head of household test, which is very important, that you must be unmarried or considered unmarried on December 31st of the tax year. That unmarried test is very specific. And again, I recommend, and I say here, to look at IRS publication 501. It is a very thick publication, but it has the hyperlinks that you can jump around in it. And it has the test that you can go through for considered unmarried. You must pay more than half of the cost of upkeeping a home, and that you must have a qualifying person living with you for more than 6 months a year. There is an asterisk there that if the qualifying person is your parent, then they don't have to live with you for more than 6 months of the year. And again, I really recommend looking at publication 501 for filing status. Next, I'm going to be talking about tax withholdings, and I do have some screenshots of what the new W-4 looks like, just as a reminder for people, because this was a change recently, just in the last 2 years or so. So just a reminder of what the tax withholding certificate looks like. So previously, it was tied to your personal exemptions with the Tax Cuts and Jobs Act. Federal personal exemptions were done away with. And so they're now calculated on filing status, income, itemized deductions, and then your eligibility for dependent child and dependent related tax credits. So the goal really was to increase the transparency, simplicity, and accuracy of the W-4. I think in a way that goal has been met. I think when you look at a W-4, it's always confusing. I feel like people never really know how to fill it out. I know myself, when I sit there and I look at a W-4, I really have to sit there and think about it, especially when you're married, you're looking at this table and you're just like, or you have 2 or more jobs, or you're married and you're looking at your table and you're like, well, what do I even fill out here? I'm not sure. Why am I looking at a table? It can be very confusing. And I'm a tax attorney and I'm looking at this table. I'm like, I don't know, let alone, your average taxpayer doesn't know either. And so I think, in a way they increase the simplicity because you're answering some questions, but at the same time, the questions are still very taxy, right? And so I don't know, exactly if we've increased the accuracy. I do have a lot of clients that have withholding issues still, despite the new W-4. And again, employers weren't required to furnish a new W-4 when the new W-4 form came out. So a lot of people still have old W-4s on file. So they didn't change their tax withholding. People also don't think to necessarily change their tax withholding when they get married or when they have, a new child born, so they have a new dependent. Maybe they're now eligible for different credits. So people don't necessarily think about things when they have new life events either, when you really do need to do a new W-4. So it's good conversations to have with your clients about their tax withholdings. So the next few slides, and you can really look at these more in depth when you have the PowerPoint, is looking at these tax withholdings and looking at the various steps. You fill in your information, you fill in your filing status that you're having there, which is important to make sure that, again, you're selecting the right filing status, because that is going to dictate a lot of the rest of your form that you're doing. And then, it's telling you, if you're having more than one job, or if you're having that married filing jointly status, make sure that you're looking again at this table and trying to figure out, okay, which one's the lowest paying job, which one's the highest paying job. Again, including these tables does make it very difficult for clients, and it can be confusing. And so that's where I think the transparency and simplicity really kind of has still been lost. But again, it's the IRS and they live in tables, and this is the way that they kind of do things. And so they do kind of break it down where if you have the 2 jobs, you list the number, you kind of do this worksheet, is schedules like you kind of always do with the IRS on things. And then you divide and you get this final number that you're supposed to use in order to get a number on your W-4. And then you kind of claim your dependents and you enter your number that you're doing by your dependents. And so you're kind of claiming that within the number, based on your income, which for, our low income clients, they would meet that number. And then you have optional adjustments that you can take deductions. You can do extra withholdings, which I have had some clients do extra withholdings, especially if it's the mid-year and they need to change their withholding amounts and they have had definitely not enough withholdings withheld. I will sometimes recommend, if they can, have extra withholdings so that they don't owe as much at tax time. But it is also, a good thing to mention is that you want withholdings to be accurate, because really people, apart from credits and things like that, but when you're looking at withholdings only, you don't really want a large tax refund when it comes to withholdings, because that means too much money has been taken out of your paycheck that you could have had every month, right? So for your clients, for refund purposes for withholdings themselves, you don't want to receive a lot back from the IRS, right? You really want it to be as equal as possible. So this is where tax withholdings is really important on the federal level and even on the state level. It's important that you get this withholdings amount right. And so I think it's really important to have these conversations with your clients about with tax withholdings and really try to understand them as much as you can as a tax professional. So I really recommend yourself looking at the form, filling it out, and trying to understand it as much as you can. Read the instructions. I've had conversations with IRS employees about tax withholdings, like prior to the pandemic, when I was able to talk to them and get some questions answered on the practitioner priority service line that they have, and be able to, understand this a little bit more so that I can describe it to my clients and tell them, hey, do the new form, so that you get that right withholding amount on there so that you get enough money to live off of every month without the fear of owing the IRS at tax time and being unable to pay them in terms of your withholdings. I want my clients to get money back in terms of credits and things like that, but I don't want them to necessarily, get this huge amount because they had too much withheld. And I also don't want them to owe because they didn't have enough withheld. And then of course they need to actually sign the form. So next I'm going to talk about ITINs. So ITINs are individual tax identification numbers. So if someone does not have a social security number, then they need an ITIN. Because if you earn money in the United States and you're living in the United States, if you earn money, even abroad, if you're earning money and you're a US citizen and you're earning money, or you live in the United States, you are subject to the United States tax laws and you have to file the necessary tax returns. If you don't have a social security number, then you need an ITIN. And so you can apply for an ITIN using a W-7 form. And David talked about on Tuesday how Prepare and Prosper is someone that is a certified accepted agent and they're able to do that. And they can bring in your documents, they can certify them without you having to send in the originals with your W-7 application. You can also go to a taxpayer assistance center and get assistance with that. And so for federal income tax return purposes, oftentimes you need those documents for immigration purposes as well. Financial aid applications, mortgage applications, other loans is you need proof of your tax return, of your ITIN and things like that. ITINs do expire after 3 years of non-use or on a scheduled basis based on the middle digits. You want to make sure that people are renewing their ITIN, which is really important because a lot of times people will apply, but they won't renew. So it's important to renew their ITIN. And the IRS is now, with the Tax Cuts and Jobs Act, no longer issuing or renewing for dependents or spouses not being claimed for tax benefits. So they might have gotten ITINs, and this is a case that I have even, that the dependents live in Mexico specifically, or another country, but a lot of times it is Mexico because there used to be agreements for Mexico and Canada with North America. And ITINs were issued for them, and they were able to claim those as dependents for certain purposes for filing status and things like that. And so they're able to do that on the tax return. But now the IRS is saying, no, you can't claim them for those purposes. So we're no longer issuing or renewing ITINs for those purposes. So now the person can't do that. And now they're unable to get public benefits like health insurance, based on family size in order to do that. And it's impacting them in their ability to get resources here in the United States. And so it's important, to talk to your clients and make sure that they're getting ITINs, and then to have conversations about the ITINs with them and how they can use the ITINs and who they can get ITINs for. So now I'm going to start talking about the credits and deductions portion of this, and just kind of defining credits and deductions so we can get an understanding of it. So a tax deduction.
Aisha, can I ask a question really quick?
Yeah.
There's just 2 questions in the chat that maybe you just want to address right now. One question is a 17-year-old dependent. Does a 17-year-old dependent need who has a job need to file? And if so, do they file on their parents or on their own? And then the second one is related. Does a 19-year-old need to file if they are still a dependent on their parents' taxes and they earn less than $4,300 a year?
So for the first, it depends on the amount that someone is earning. And if someone's being claimed as a dependent, then they don't need to be filing their own tax return if they don't meet the filing obligation requirements. And so if someone's being claimed as a dependent, then they don't have to be filing their own tax returns. So no, even if they're 19 years old, if they're being claimed as a dependent, because if for example, they're a student, and they're being able to be claimed as a dependent, or if they were disabled and they're being able to be claimed as a dependent, they just had to meet the dependent test to be claimed as the dependent, then they wouldn't have to be filing a tax return at all. And the 17-year-old could file their own tax return, and that's something that could be put on the parent's tax return, or it could be put on their own tax return. It would just depend again on the filing obligation and if the parents, it kind of gets down. I would talk to the tax preparer about whether it's beneficial for the parents to claim them as a dependent, or if it's more beneficial for the dependent to be claiming their own tax return for tax purposes. I would think with some of the credits for 2021 for a 17-year-old, it would often be more beneficial for the parents to still claim the child and then include the income on their own tax return. But I would have them talk to the tax preparer to do the benefits analysis of that.
You.
Yeah, no problem. Great questions though. So for credits and deductions, a deduction reduces the amount of income that they will pay taxes on, resulting in a lower taxable income. So so you have above the line and below the line deductions. And so that will result in either way a lower taxable income overall. A tax credit reduces dollar for dollar the amount a taxpayer actually owes. And tax credits can be refundable or non-refundable. And that's really important, because if it's refundable, and I'll kind of talk about this more too when we get to credits specifically, but if it's refundable, it's really important. And we have a lot of refundable credits for 2021 that normally aren't refundable. Because it's refundable, then the person can actually receive the amount. If they don't owe taxes, then the money gets straight to them, instead of just kind of being like, oh, well, you don't owe money, well, then you don't get the money, and it just kind of disappears. So I'll talk about tax deductions first, and that's a shorter section because there aren't as many that are as applicable to like lower and middle income. And quite frankly, the Tax Cuts and Jobs Act got rid of so many deductions for individuals, and it really is more about credits for individuals for getting money than it is deductions for individuals that are lower and middle income. And so I'll talk about the federal standard deduction. And I kind of talked about the standard deductions a little bit different this year, you'll kind of notice. But there is a difference. And I always do kind of note the difference still with the Tax Cuts and Jobs Act. The federal standard federal deduction has increased for 2018 to 2025 with the change of the Tax Cuts and Jobs Act, and it is based on filing status. And so you can kind of see the standard deduction in 2017, what that looks like. So it was a lot less because you had your personal exemptions, which kind of made up a difference. And then in 2021, you have your standard deductions, which go with those amounts that you'll kind of notice with the filing obligations. You'll notice that that is also the standard deduction amount, because for your filing obligation, your standard deduction amount, they kind of usually zero each other out. And so you'll kind of see that standard deduction amount for single is $12,550, married filing jointly that $25,100, married filing separately that $12,550, and head of household $18,800. And so it's important for people to know, again, their filing status to determine their standard deduction. I cannot tell you how many times I have clients do head of household filing status get audited by the, and they have dependents because you need those dependents for head of household, and they're not married. So instead of doing single, because otherwise you would do single. So instead of doing single, they do head of household. They do head of household, plus they claim their dependents for credits purposes. So they do head of household instead of single. And then the IRS audits them and they are denying them their dependents for their and their credits. And then they're denying them that head of household. And there's a huge difference then in that standard deduction. And then they end up owing quite a bit in taxes and then interest and penalties. And so it's so important that people get the right filing status and that they have documentation. And I'll talk about this for dependents. People need documentation for the filing status that they're choosing. So if you're choosing head of household filing status, you need that documentation that you're unmarried. You need the documentation that you provide more than at least half, like half or more of the expenses for the household. So you have your bank statements, you have your receipts, you have things showing that you are providing for the household. You have your sources of income showing that, you're bringing in whatever income sources that are there for the household. You're showing that you're spending it on the household, and then that you're showing that you have those dependents. So then you have the qualifying dependent tests that you're meeting for the dependents. So you have documentation for that. If you're doing married filing jointly, you have the documentation, like you have your marriage certificate. Even like I cannot tell you how much having a marriage certificate has actually helped. Or I need to show that, someone, falsely, another spouse falsely filed married filing jointly, and it shouldn't be married filing jointly. So then I need to show that they weren't married, right? So I need to argue a lot of times filing status, which then affects standard deduction amounts. So that standard deduction amount and that filing status, again, are so connected and so important for low income taxpayers. I wanted to show the state standard deduction amount and exemption, because there are exemptions at the state level for Minnesota, and the state standard deduction amount is slightly different by $25 for every status other than married filing jointly. So when I was looking at the state information, I was actually surprised that there was a slight difference. So I wanted to note that for people, that there's a slight difference this year for the state standard deduction amount. So I wanted to note that just so people had that information when they're talking with clients. And if you do tax returns, you probably know that information already. But if you just are talking with your clients, or if you're looking at tax returns and seeing the different number amounts, you know why there are slightly different number amounts. And so again, for deductions, that Tax Cuts and Jobs Act did drastically change which federal deductions are available. Because again, Tax Cuts and Jobs Act, I just want to note again, is federal. So a lot of things I mentioned again are federal. So I just wanted to note again, that is a federal change. That is federal, not state level. So again, with Minnesota, they didn't take that personal exemption amount away. So that at $4,830, like difference is still there for that amount for dependents, but it's not there on the federal level. So that personal exemptions aren't there. You cannot deduct alimony payments. You can't deduct miscellaneous itemized deductions, moving costs, like so many different things that you can't be deducting. Not related to the Tax Cuts and Jobs Act, but related to legislation in 2020, you can no longer do the tuition deduction and expenses specifically. That was repealed for 2021 and 2022. So last year I actually talked about it in this presentation because it was still allowed for tax year 2020, but it was repealed in 2020 for 2021 and 2022. So I just want to note that if you were here for last year's presentation, that was one of the available deductions I talked about. It is not available anymore, so I won't be talking about it this time. So the available ones that there are student loan interest deductions. You can do up to $2,500 from your taxable income. So to be up to the $2,500 or up to a certain percentage amount, you'll get a 1098E. You can do that charitable donations, continued from 2021 to from 2020 to 2021 is you can take $300 or $600 from Married Filing Jointly for above the line deduction instead of it being always itemized. And then there is a reduced amount on the charitable contributions permitted to be deducted. You still have those medical expense deductions for qualified unreimbursed medical expenses that exceed 7.5% of your adjusted gross income for that tax year. That can actually be really helpful for a lot of my clients that are in nursing homes or other care facilities. They might have pensions, they might have Social Security income, they might not be having taxes withheld because, quite frankly, all of that income then goes to the care facility and they end up getting like $100, $106, $110 of actual money out of it every month. That then goes, for paying for like small personal expenses that really ends up like not paying for enough, and their family ends up having to pay for so much of their individual like things, right? And so one way that I've talked to tax professionals about a way to make it so that they don't owe money all the time on their tax returns is to itemize their medical expenses deduction if that is something available to them. So I recommend, if you have a client in a situation like that and they end up owing all the time, looking and seeing if they can do a medical expenses deduction to reduce what they owe is something that I have found is actually something that is available to some of my clients, not all of my clients, because they might not have qualified unreimbursed medical expenses for everything, because some things might be like through the county and however it's set up, but they might have some things that do qualify for that exceeds 7.5% of their AGI, especially those clients that receive pension income as well. That mortgage interest deduction, allowing you to do that. A lot of clients don't think about gambling loss deductions. And then that self-employment expenses, which is really important, like home offices, business, internet, telephone, fax, travel, vehicle use that is business vehicle use. So if you use it for personal and business, it has to be the percentage that is business and you have to record that. So everything also has to be concurrent records of everything, which is really important. People often use a calendar. It technically should be more than a calendar, writing it down, but U.S. Tax Court and the IRS will sometimes accept a calendar. Education, rent, advertising, and use Schedule C of the Form 1040. Just know for home offices, that is for self-employment purposes, something like a W-2 employee cannot take an expense for a home office. So now I'm going to get into tax credits, which is a big portion of this. I did talk about a lot of these credits though on Tuesday, so I'm going to go through them fairly quickly in order to make sure that we have some time as well. So again, I'm talking about those types of credits. There are the refundable credits. We reduce the amount of tax owed, and any remaining credit is then refunded back to you. So if you end up owing $1,000 in taxes after withholdings and everything else, and you end up owing $1,000, but then your credits are $7,000, it's $7,000 minus $1,000. If that rest of it is all refundable credits from 2021, then you get $6,000 sent back to you and a check from the IRS. So that's how it works. But if it's non-refundable, it can reduce it, and it can reduce it down to zero, but then you don't receive any of the remaining credit amount. And so you don't owe anything, but then you don't receive any portion of that non-refundable credit. So you receive anything for refundable, but not anything non-refundable. And so claiming credits, you would do that on your Form 1040 for your federal. You do it on an M1 for the state. And then for state property tax, you do an M1 PR. So I want to talk a little bit about claiming dependents, especially, it's on a federal and state level because of the state, they use the federal test as well. I talk more about this on Tuesday. So I really recommend, again, looking at that Tuesday recording, because I actually write down the test on Tuesday in a slide, and I didn't want to spend as much time on that this time. But claiming dependents again affects your filing status, your deduction, and your credits, like I've talked about. There are qualifying child and what's called a qualifying relative, and there are very specific tests. They're very specifically defined by the IRS, and I talk about that on Tuesday about the different requirements for them. And for credits and deductions, most of them have to be a qualifying child. There are age requirements associated with them, which I talk about more on Tuesday. And a dependent can only be claimed by one taxpayer in a tax year. And so that can be an issue with a lot of our clients, is it's often first to file, especially electronically. Someone will file a child with the social security number. Someone else who is actually supposed to claim the child will go and file, and they're unable to claim the child, or it will allow it through. And then there's an audit, and really the person who is supposed to actually claim the child, might have been second in time, is actually audited by the IRS, has to prove everything, ends up with a headache of everything, comes to us, and this can end up in years of litigation with the IRS, just because someone improperly claimed the child, and instead of them being audited, the person who properly should have claimed the child was. And it requires you, again, to be prepared with a lot of documentation. You have to establish that relationship, residency, support, and your priority in claiming the child. And there's a lot of records that you need to be able to have in order to prove that. And I list just some of them here. And properly claiming a child can result in the loss of the right to claim the child, having to repay a refund, and paying additional taxes and penalties. So it's important that clients properly claim dependents, and they can talk to a low-income taxpayer clinic and get advice on whether or not they should claim a dependent. And if they ever do get a notice about an assessment or a preliminary change or preliminary audit, about being audited, about being in collections, about claiming a dependent, have them contact a low-income taxpayer clinic, because we can answer their questions, give them advice, and we can actually assist them through the audit process. And we can do that in various ways. I'll talk about, it's both us at Mid-Minnesota Legal Aid, and also the University of Minnesota has a low-income taxpayer clinic. And I always suggest both of us, because we are both available, and both are busy, have intakes. And so, please choose one of us to do that. Talking about the earned income tax credit. So a kind of a first one about dependents. So you have to have earned income or self-employment income, unemployment compensation, not earned income. Continued from 2020 to 2021 is you can use 2019, or that should say 2020, adjusted gross income for determining your eligibility for tax year 2021 earned income tax credit. The taxpayer must have a social security number, and the qualifying child or children must have social security numbers. So that's something to know, is everyone must have a social security number. New for 2021 is there is no age maximum. It used to be 65. There is no age maximum. They changed the age range. You must be a United States citizen or resident alien. You cannot be anyone else's qualifying child or dependent. And then new for 2021, you may file married filing separately and claim the earned income tax credit if you meet certain requirements. I talk about those requirements on Tuesday more in depth and give the test. So I recommend watching that recording. So this is the chart looking at the number of qualifying children, your filing status, and then the maximum credit that it goes up to. And that maximum credit is then, the maximum amount, based on your income level. There again are charts in different publications by the IRS that you can look at the number of children, your exact income, and the exact amount of your credit. So if your client is interested in doing that, there are tables that you can look at with the IRS for each of these credits. And you can look and see at your exact amount that you'd be eligible for, or you can just look when your tax return automatically does it for you when you're looking at when you're e-filing. And I do recommend, the IRS is so far behind on processing 2020 and 2021 tax returns. There are still millions of paper tax returns that are not processed yet. Like there are over 10 million tax returns. And so highly recommend e-filing. E-filing, even though that can even be a little bit slow with getting refunds, it will be processed so much faster than paper returns. So really recommend e-filing, and that would be to me, oftentimes it can be the most accurate in making sure people, take advantage of all the credits available to them. And then on the Minnesota side, there is the working family credit, which is the Minnesota version of the earned income tax credit. And you must be a full year or part year resident in Minnesota and meet the requirements of the federal earned income tax credit. And you can see again, based on your family of number of qualifying children, your filing status, and then you can get your maximum credit amount based on that. And then we'll talk about the child tax credit. And again, I go a lot more in depth on the child tax credit on Tuesday's presentation. And so again, I really recommend for these next few dependent credits looking at that Tuesday presentation because I go a lot more in depth about these new changes. And so I'm just brushing across them right now. But the child tax credit is really designed to give a boost to parents or guardians of children or dependents. And really for 2021, it truly was a boost of financial support with these, what was given as advance payments. And it really did bring families out of poverty. It gave them a chance to get money each month to really try to support their family, to provide for basic necessary expenses and really try to meet the needs of their children and families every single month. And they really did find that it did. And they're finding now that it ended, as so many things ended, right? Unemployment compensation ended. A lot of the rental assistance, evictions are happening, the moratoriums ended. Now like rent help, and then, is ending, this week. Tomorrow, actually, it's ending. So, last time to file, and get your application finalized and in. All these things are ending for people, and they're finding people, are struggling so much. And, they're finding that, with inflation and with, prices skyrocketing, what are people going to do? And, the unfortunate thing is things like the advance payments and things like all these credits that I'm talking about and all these changes were only for 2021. The legislation, the American Rescue Plan Act that enacted these changes was only for 2021. And unfortunately, legislation was not passed for 2022. And the hope is that it will, the hope is that it will. The hope is that maybe there'll be more economic impact payments. Maybe there will be more things with a pandemic still going on. But the thing to note for clients is that there isn't anything right now. And we need to keep that in mind. And how can we support our clients who are going through such financial difficulty, because there was support and now all of a sudden all that support was taken away from them, and what can we do to support them right now? What can we do to help give them some stability? What can we do just to be someone who can be understanding and compassionate and provide them holistic services? And not just, something I can just know, for something that, is so important in something like this child tax credit. And how can we make sure that people maximize their tax refunds? And like we talk about on Tuesday and in the resource guide, how can we maximize these money moments with these tax refunds? Because this is a time when people have money with these tax credits, and how can we make it so they can use this money and keep this money and have that money moment throughout the rest of this year, during this pandemic. So for 2021, it was a fully refundable tax credit. The dependent age limit increased to 17. The maximum amount was increased from $2,000 to $3,600 for children under 6 and $3,000 for 6 through 17. Again, there was those advance payments of up to half of the eligible tax credit. There's a letter 6419 being mailed out that will give information about the amount of advance payments that the IRS says that was received or mailed out and paid out. Again, people will want to pay attention to that because it's technically an amount that you would put on your Schedule 8812 if you're trying to figure out your worksheet for what remaining amount you will put on your tax return, but you're not putting that amount itself or reporting it on your tax return. What you're reporting on your tax return is the amount that you are claiming you are still due. So if you received, if you have a child that's 4 years old and you received half the amount, you received $1,800, so you are claiming $1,800 on your tax return for the child tax credit on your tax return because you're claiming the other half. And it's important that, again, there's no earned income requirement. So basically everyone that has these eligible dependents is eligible for the child tax credit this year. So it's important that they file a tax return and claim the other half. And I talked about that on Tuesday. Children must have social security numbers, but the taxpayer can have an ITIN or a social security number. And taxpayers who have non-child dependents, I just want to note that there is a credit for other dependents credit, which is a $5 non-refundable credit. So they might be eligible for that credit. If they don't have qualifying children for the child tax credit, there is a $500 non-refundable other dependent credit that they might be eligible for. So the child independent care credit, there is both a federal and Minnesota one. So I just wanted to note that. I talked a lot more about this on Tuesday as well. So it's a qualifying one for children under 13 or a disabled spouse or dependent. You must have the earned income, paid someone, have them live with you. They have a social security number or ITIN. Your household income, though, has to be less than $65,630 for one dependent or $77,630 for two or more. And that is a Minnesota state credit only requirement. So I wanted to note that for Minnesota, there isn't that exact amount of income requirement for the federal, it is for state. Only for 2021 for federal, you can claim up to $8,000 of qualified expenses for one child and 16 qualified expenses for two or more. And then your maximum credit amount is half of those amounts, and it is fully refundable. For Minnesota, it stays of the claiming up to 35% of the qualified expenses. And for one dependent, it's $3,000. For two dependents or more, it's $6,000. So then you have that 35% amount, and again, it's based on your income. And there is a table that you can look at that depends. It says your income amount, and it'll give you the amount of percentage that you can point your expense by. So based on your income, it can go down to like 0.2 as your percentage that you can do times your income. So from 0.35 to like 0.2. And so there is a table that if you're interested with a client, you can look at that. You must have the provider's name, address, and taxpayer identification number. And I talked about that a little bit already, and then talked about it a lot on Tuesday. And if you are married, you must do married filing jointly. This is one that you cannot do married filing separately. There is the Minnesota K through 12 education credit and subtraction that is limited to 75% of allowable expenses. And so the maximum credit is $1,000. Maximum subtraction is $1,625 for each qualifying child in K through 6 and $2,500 for grades 7 through 12. And so there is the maximum household income. And it is $37,500, but it increases by $2,000 for each additional child. And there are some qualifying expenses, education materials, tutoring, fees for all-day kindergarten, tuition for summer camps. You must make sure you keep itemized receipts for the educational expenses. Just like everything, I really recommend that people keep receipts, documentation, everything for at least 3 years, because that's generally how long, you can go back and claim credits, and deductions and things like that up to 3 years on tax returns. When you do amended tax returns, you want to keep things for at least 3 years for those purposes. And then oftentimes, the IRS or state will go back, can go back, 3 years. They can go back even more and longer. But, oftentimes we tell people to keep at least 3 years. The American Opportunity Credit and then the lifelong learning that I'll talk about is post-secondary education. So the maximum credit is $2,500 per student, up to 1,000 of which is refundable. There is adjusted gross income requirements and it does maximize out. This is for tuition, enrollment fees, required course materials. You get a 1098T. And you must be pursuing a degree or a recognized educational credential, which does make it different than lifelong learning. Enrolled at least half time, not have completed the first 4 years of post-secondary education at the beginning, not convicted of a felony drug offense, which is important for the federal level, the American Opportunity Credit, not claimed the credit 4 times, and you can have a social security number or an ITIN. For the lifelong learning, this is non-refundable. The maximum credit is the $2,000. There is the AGI again is the same with it maxing out. You may claim if it's a taxpayer, the taxpayer's spouse or dependent just require the post-secondary education and you're not eligible for that American Opportunity Credit. You don't have to be pursuing the degree or the credential, and there's no limit of number of years. So a lot of times, if you're not eligible for that American Opportunity, which does have the portion be refundable, then do the lifelong learning and it is non-refundable. The qualifying expenses are the tuition and fees and educational materials that are actually purchased from the post-secondary institution. So not a book you purchase from Amazon, but if you purchase the book from the actual school, then you can actually do it as a qualifying expense. So now we'll get to the homestead credit refund and then like the property tax, property tax refund and the renter rebate refund. So these are state credit. They're based on income and property taxes that will be paid in 2022. You have to be a full or part-time resident of Minnesota, own and live as of January 2nd, 2022, classify the home as your homestead. You must have a social security number. Your income must be below 119,790. You cannot be a dependent of anyone else, and that is an important factor as well. Have paid all your property taxes or have the arrangements to do so on a schedule. The maximum refund is $2,930 for this year, and then the deadline is August 15th, 2023. For the renter's property refund, it is refundable. Again, it's based on your income and amount of rent paid. You'll get a certificate of rent paid issued. If you don't, then you can request it, and there is a process through the Minnesota Department of Revenue. If you don't get your certificate of rent paid, you should get that by the end of January from your landlord. And if you don't, there is the process. You can go through Minnesota Department of Revenue and say, do an affidavit that you did not get it. This is the amount that you paid. And you can talk to them, and there's a website, if you search renter's property tax refund or certificate of rent paid, there's information on the Minnesota Department of Revenue website about doing that. And I've talked to them about renter's property tax refund, even though I don't do it. They're very nice, and I recommend talking to them about it. If you have a client situation, I found them very helpful. But you must live in the building where the property tax is assessed, be a Minnesota resident, paid the rent. You can have a social security number or an ITIN. Again, not be a dependent. The household income is below $64,920. Have that certificate rent paid. The maximum refund is $2,280. And that deadline to file again is August 15, 2023. I just want to mention recovery rebate credit. It was the economic impact payments that were the advanced refundable credits for tax years 2020 and 2021. There have been 3 of them. The third one was in 2021. So if someone did not receive it or did not receive the full amount, they'd be claiming it on a 2021 tax return. The IRS is sending out letters 6475 stating the amount that was issued in 2021. So the economic impact payment is the recovery rebate, line 30 on the 2021 tax return. The recovery rebate is treated as a refundable credit, but unlike the economic impact payments, which I talk about on Tuesday more in depth, they may be subject to additional refund offsets. So it's important to note that the economic impact payment wasn't subject to offsets, but the recovery rebate credit is, because it is on the tax return as a refundable credit. So some post-return filing considerations just to think about. does the client own any federal or state agencies? Because then there'll be refund offsets and revenue recapture. And it's not just do they owe the IRS and Minnesota Department of Revenue, but do they owe other federal agencies? Do they owe any court fees? Because the Treasury offset program through the IRS, well, through the federal government, it's not through the IRS, but they'll think it's through the IRS. But through the Treasury offset program, which is just through the federal government side of things. And then the Minnesota Department of Revenue actually does it through the state agencies. And so like if they owe anything on the state side for things, if they owe any like student loan things, it'll come through MNDOR. So they think it's state tax debt, but it's not. There'll be revenue recapture and they'll take their state tax refund, they'll take federal tax refunds. And so it's important for them to be aware of that. Do they have those sufficient documentations to support that filing status, those credits and deductions if they are being audited, keeping those 3 years? Are they just becoming aware that they're eligible for a credit or deduction from a previous tax year? And then they'll want to file an original or amended return within the past 3 years. And then something I wanted to add is, did they recently move? Because they'll want to update their address with the IRS so that they get IRS notices. Because I have so many clients who move so often and then they never get the IRS notices. So then the IRS is taking all this action against them and then they start levying and garnishing and they're like, why are they doing this? What happened? And the IRS is like, well, I've been trying to contact you for the past 3 years and you never responded. And so now I'm taking your money. And so it's really important that clients, when they move, they update their address, and they can do that on their next tax return. If they file tax returns, they can call the IRS. Quite frankly, good luck trying to get a hold of the IRS right now. They can do it in specific writing to the IRS with their name, their social security number, their address, their telephone number. If they send that to the IRS and they send that to the last place that they file the tax return to, or quite frankly, what I recommend people do is they mail an IRS form 8822 to the IRS. And usually it takes 45 days for the IRS to process that and have the new mailing address on file. The resource guide that we have is really great. And I recommend that people use that resource guide it has so many resources that we have in there for the different levels and areas of tax law and different professionals that are available to assist with taxes in Minnesota. I just want to highlight here the ones that I deal with the most with credits and deductions, right? And talking about this. On the federal level, there's the Taxpayer Advocate Service, and I provide their website. They provide services with really what they're meant to do is if a taxpayer is in an emergency situation and they're unable to resolve an issue with the IRS, the Taxpayer Advocate Service is there to help. That's the idea of the Taxpayer Advocate Service, is what I will say. And if someone is in an emergent situation and they need our help, we can help them get through to the Taxpayer Advocate Service as well in order to help resolve that issue with the IRS. The Taxpayer Advocate Service is an independent part of the IRS to try to resolve issues with the IRS. There's also taxpayer assistance centers. There are 6 of them in Minnesota, with 2 of them in the Twin Cities area in Bloomington and St. Paul, and the other ones in outstate Minnesota. And then and I talked about this on Tuesday, there are areas where people can go in person to resolve issues with the IRS. When the state level, does it take taxpayer rights advocate, which is similar to the taxpayer advocate, local taxpayer advocate, which we have on the federal level, which is part of the Taxpayer Advocate Service. For tax preparation, we talked about on Tuesday, and with David, there's the VITA and TCE site. So I just included this site on the Minnesota Department of Revenue, which David talked extensively about how you can find free tax preparation sites throughout the state of Minnesota. And then I have to plug, if you have tax dispute representation and advice information, come to us as low-income taxpayer clinics. Mid-Minnesota Legal Aid is my program. I provide our website. And then the University of Minnesota Tax Clinic, they are available as well. And they are led by Caleb Smith, who's the professor, an amazing tax attorney. And then he has 10 students that work with him as well through his clinic. And they represent taxpayers as well. We each do similar work working with low-income taxpayer clinics, each kind of working on cases, representing people, and we represent throughout the state of Minnesota. Again, I want to say that we represent throughout the state of Minnesota. So it's not just thinking about us through the Twin Cities, but both of us represent clients throughout the entire state. So if you have outstate Minnesota clients, if you are from outstate, we represent your clients. So if you have any questions or referrals, this is my information. Please reach out to me. Please email me with any questions. If you need advice about anything, I can do consultations with professionals. If you want to do outreach and education, I do tons of that. Please reach out to me. If you want to do a Facebook Live together, I do a series of Facebook Lives every year. Taxes, on taxes and tax issues. So contact me about that. And then I have our intake number if you have client referrals. That's 612-334-5970. So I will take questions, and then just a reminder, thank you to all of us, and to make sure that you do our evaluation so that we can improve everything. And we will send out the PowerPoint and then this recording as well. So I'm going to end sharing my screen so that I can then see everyone and be able to answer more questions.
Thank you, Aisha. You are such a wealth of knowledge, and we so appreciate it. I think that there's a couple questions coming through the chat right now, but there was one that I just wanted to catch before others. Somebody asked, for married couples that purchased a home, would it be better to file joint or separately, or it depends on a case, or is it case by case?
Generally, it's best to do married filing jointly, because actually with married filing separately, I was just looking at that, and I'm not sure if it's that credit, but there is a related credit that you cannot do if you're married filing separately. So I would talk to the tax professional, but generally I was just looking at that, and I was thinking to myself, married filing jointly.
Thank you. And I just asked folks in the chat if please put your questions in there, or you can also unmute. We do have, Cassie has one question. Does the Minnesota Legal Aid help people with tax debt negotiate with the IRS?
Yes, that's actually the main thing that we do is I can talk a little bit just shortly. We do tax disputes with the IRS. And so when people are being audited, then we, go and do substantiation documents and negotiate them. We even go to U.S. tax court with them and represent them. But the main work that we do is collection alternatives. So people are being collected against by the IRS. They might already be levied and garnished against, or they might be threatened by it. Or they just might not be able to afford their debt, and they might be the beginning of that. We negotiate their debts with the IRS. We make it so that the IRS accepts no payments from them, and we do temporary collection suspension. We might put them in installment agreements so the IRS accepts a low amount every month in order to pay off the debt. Or we might do what's an offer and compromise, which might be something that you're thinking about, where we negotiate to pay the debt for less than the amount owed. So a lot of times we negotiate debts for $5 to $100 instead of being thousands of dollars, up to, I think we've done up to over $100,000. And we negotiated that for $10 or $15. So that is often things that we do for low income taxpayers. And that's actually the bulk of what we do for our clients.
Great, thank you. Other questions that folks have? I don't see any in the chat, but please feel free to unmute and ask them. So Cassie just followed up to ask, what is the income limit for people to work with you, Aisha?
Yeah, so for the low-income taxpayer clinic, so this is both us and the University of Minnesota. So if you want representation services, it is 250% or less of the federal poverty guidelines. So that's representation. So that would be if we would be able to accept the case for representation and kind of walk through the whole case and do power of attorneys and things like that, and actually speak to the IRS, right? But if someone just wants advice, If someone just wants us to talk to them, look at their documents, kind of review stuff, kind of talk them off a ledge, even, and just kind of help them understand what's going on. We even sometimes ghostwrite things for them, ghostwrite cover letters, do things like that. That there's no income limit. People can have any amount of income and I can give them advice. So there's no income limit for advice. So I actually, as a clinic, I have goals every year. So I have a goal of amount of representation cases I do, and then I have a goal of advice cases. So I actually do more advice cases as a goal than I do representation cases. And so we do a lot of advice cases for people regardless of their income limit.
Thank you. Other questions? Maybe why folks are thinking of those questions. Just a reminder, in the chat, someone asked this, but the recording and the PowerPoint slides and the resource guide will be sent out again, and I will send out both part 1 and part 2 so that everyone just has everything. And we will also be sending out an evaluation. So Aisha, thank you for reminding me of that. Because we really want your input in, how this, what information that you loved and what information was maybe missing, right? So we can continue to improve for next year.
And Aisha, this is Shawna. I just want to thank you for making yourself so accessible too, for all of the education and all of just getting out into the community, because I think these topics are not easy for folks who don't have their heads wrapped around it every day. And so I just appreciate you making yourself available to take questions and, outside of this training and everything. So thanks so much.
Definitely.
Okay, if there's no other questions, we will end the webinar, but if you have something you want to stay on, that's great. We can maybe stay on for a few minutes. But thank you, everyone, and especially echo exactly what Shawna said, and I think others in the chat too. Thank you so much, Aisha, for your expertise and willingness to support our families across Minnesota. This is a wonderful resource that you all do. So thank you, everyone. Stay warm and take care. And if you have any follow-up pieces that you'd like to, that you need from us, please don't hesitate to reach out. So thank you so much and have a great day.